Hey guys, welcome back to the channel. If you are new to Mommy Trader, welcome. I'm so happy that you are here. I hope that you can find some inspiration so that you can get started on your own wealth building journey. And if you are a returning subscriber, virtual hugs. Thank you so much for coming back. I do appreciate you being here. So we're going to be talking about why you need to be investing / saving for retirement. I know it may feel like it's so far away, or you will be able to rely on Social Security or things like that, but I can tell you that I don't know what it's going to look like in the future, but the best way to prevent any disappointment is to create your own plan. I'm going to tell you just a couple of things that you can do to get started, whether you feel like you are late to the game or not, or perhaps you don't know what to invest in, what type of accounts. We're going to talk about that today, okay? So I really hope that you guys enjoy this video. So retirement is so important. I think one of the things that you have to ask yourself is, what does retirement look like to you? A lot of times, a lot of us say we want to retire, but we don't really, and I talked about this in a previous video. I'll link that up above, but what does retirement look like to you? Because once you figure that out, you have to put a number to that. Do you want to retire a millionaire? Some people don't need $1 million to retire. You really need to kind of sit down and figure out what retirement for you is going to exactly look like. And once you do that, you have to put that plan into action. You have to put it into play. You got to get started moving, because remember, time is your friend when it comes to investing, any type of investing, whether it's in yourself, whether it's in your retirement, where maybe it's to buy a home. You know, the sooner you start, the better. And so one of the first and best ways I recommend, though I'm not a financial advisor, that I recommend anybody to get started with investing, that's your 401k. That's your company sponsored plan. Head on down to your HR person, your benefits person. You should probably have gotten some information in your, orientation packet that you got when you first started your job. And if you don't have it, you can go and just ask and they'll be able to direct you. A lot of this information is online as well. You just gotta go and get your log on credentials from your HR person, and they'll be able to set you up with that. But 401k, 403b, whatever it is that you have access to through your employer, that's the number one place I suggest that you start. A lot of times you get matches, which is like extra icing on your cake, is when you can get a match on your retirement. Now, there are different types of matches that different employers offer. Some people get 10% match, which is super great. Some people get 5%, some people get none. So you want to make sure that you understand how much match does your employer have, if they have one. And the great way to kind of go about this is just invest up to the match. So you don't have to worry about if you don't have an extra $700 a month to put in your 401k. We started with $100 because that was the best that we could do, and we just slowly build from there up to the match, and then we started exceeding the match as well. And remember, the match is extra money when it comes to your investing. It's free money. There's really no gimmick to it. There's no like, oh, they're going to pull the rug from under us. A match, a 401k match, that's what it is. It's free money. They are actually incentivizing you to invest in your future. And also, you know what investing in your 401k does? It lowers your taxable income. So that means you don't pay as much tax right now as you normally would if you did not put anything in your 401k. Now, granted, in your later years, you will have to pay tax when you withdraw that money, but 9 times out of 10, your income tax rate will be much lower later in life than it is right now during your, the majority of your working years. So your 401k, that's the first place I suggest you go when it comes to investing. The second thing is your a Roth IRA. A Roth IRA is one of the secret sauces to investing. And just as a tidbit here, you can have more than one investing account. Even for retirement, it's not just like a one size fit all. With your 401k, that's pre-tax. That means before that money hits your bank account, your employer have already taken that money out and put it in a retirement account for you, which is great. You don't see the money. You don't have to feel like you got to do the work to transfer it. They do it for you, which is really, 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 really awesome. And so the great thing about the Roth is that you have more control over that. Now, your Roth is after tax income. Those are the contributions that go in there. So once your paycheck from your job hits your account, so you already put some money towards your 401k. You never saw it. They took it out pre-tax. But now your money hit the account. That's your post-tax income. That's with all your deductions and your 401k and, taxes and all that taken out. That's the money that hit your account. You can open up a Roth IRA. That's considered a taxable brokerage account as well. So this is what you put your after-tax dollars in. One thing I love about the Roth is that money grows tax-free. Why? Because the money you put in there was already taxed, which is like really great. So if you max out your Roth IRA every year, I believe it's $6,000 up to a certain amount. I think it's $200 for a married couple. Correct me if I'm wrong, guys, but I believe it's $200,000 up to the limit for a married couple, and then they start to phase you out. But and we'll talk about the backdoor Roth in a second. But the Roth IRA, you can contribute up to $6,000 a year, and the great thing is that they'll let you continue to make contributions for the tax year until April of the next year. You just can't file your taxes yet. But again, talk to your tax person just to run through your personal situation. But a Roth is great because that money grows tax free. So you can retire as a Roth IRA millionaire. It's really, really, really possible. The next type of account that you can have is an HSA. That is a health savings account. Now, if you have a high deductible in terms of your health plan, and you are in, overall decent health, this is really good for like those who are in their 20s and 30s, and even like I would say 40s as well, because you know yourself. A health savings account is a great way to also start to save for retirement. A health savings account is offered through your employer. They will take the money out. Usually they will take the money out for you, like with your 401k, and put it in a separate account for you. The great thing about an HSA is that there are 3 major tax benefits. The first one is that the money that you put in there is pre-tax. So just like your 401k is not taxed, this is not taxed as well. You pay taxes later down the line in your later years. So you contribute pre-tax. The second thing is that money does grow tax-free, which is so awesome. All those gains that you get, it grows tax-free. And also the third thing is that when you take that money out and you use it on qualified medical expenses, and the list of qualified medical expenses is getting larger and larger, which I'm so happy to see. But when you use it on that, you don't have to pay tax as well. Usually when you put money into an investing account, if you don't pay tax for it, then you have to pay tax for it later. But the HSA, if you use it on qualified medical expenses, you don't pay tax either way. But here's the loophole here. This is the big kahuna right here. Any out-of-pocket medical expenses that you pay from your own pocket, save all those receipts up. Download an app on your phone, on your computer, keep a tracker, a spreadsheet, something. Take a picture of it, keep all of your receipts, and you can reimburse yourself from your HSA years down the line. So let's just say for 10 years straight, you decided to put $300 a year in your HSA because you have a family. There are income limits for that as well. For a family, we can contribute up to $300 per year. And this is as of this recording of August 2021. But if you strictly put $300 a month into your HSA, let's say you have a balance at the end of 2 years of $25,000, let's just say, but you've been saving your receipts that whole time as well, you can actually pay yourself back from your HSA and don't have to worry about any taxes, because there is no stipulation in terms of length of years in the future that you can reimburse yourself. That means if I'm paying for all of our medicines, if I'm paying for any health expenses, any co-pays, anything like that out of pocket, I'm saving all my receipts. And when we hit early retirement, I'm going to go onto that HSA website with all of my receipts, and I'm going to calculate all of them up, and I'm going to reimburse ourselves back tax free. I love HSA accounts. Let's talk about the backdoor Roth. So let's say you make more than the income requirements for the normal Roth IRA like we do. Well, there's something called a backdoor Roth. Backdoor Roth is basically putting a chunk of money, and this is what I suggest you do because this is what we're doing. Because you want to make sure that that money doesn't have time to grow, because when you convert it, you're going to have to pay taxes. So what we do is save up the money for our backdoor Roth, because we want to do it in just one shebang, one transaction, one process. We save that money in a sinking fund account over in Capital One. Once we get the desired $5,000-$6,000 that we want to put into our backdoor Roth, we're going to transfer that money from Capital One into a traditional IRA account with Fidelity. We're going to let it sit for a week, let all the money clear and things like that. Once a week go by, we are going to convert that traditional IRA into a Roth IRA. And we have to pay, if it grew, that money sitting for a week, if it grew any in that week, we pay the taxes, which is probably pennies, to be honest, and convert it over into the backdoor Roth, and that money will just grow tax-free. That is basically, in a nutshell, a backdoor Roth. So if you make more than like I said, the allotted income, I'll have an article to the website where you can see the income requirements for a Roth IRA and the backdoor Roth, so that you guys can go back and take a look. But that's just, something that we're doing because we make over the income requirements for the traditional IRA. Traditional Roth IRA, Let's say you decide to start your own business. You have your own side hustle. You started your own company. I know a lot of you guys are doing that or thinking about doing that. You can open up a SEEP IRA or a solo 401k because you are considered self-employed. Well, those have major tax benefits as well. And usually you can contribute more than $6,000, more than the $19,500 in your 401k. I think it goes up to like $58,000 or something like that. We have one for my husband's business, and when MT, Mommy Trader, kind of gets off the ground and going, I will open one for myself as well and hire my daughter and open up a Roth for her as well, because she's good at the thumbnails and stuff. And so these are different accounts that you can have all simultaneously that will help you get to your retirement goals quicker. It's so important to save for retirement, and there are many vehicles that the IRS, they are rewarding you for investing in your future. It's really funny how this stuff isn't taught in schools. I wish I would have known about a Roth IRA in my 20s while I was just out there partying. But we knew at 30. And we know now. And so I'm just trying to get this information out there, especially if you are younger, still in your 20s. It's never too late to start, even if you're in your late 30s, 40s, even 50s. As long as you are continuing to work, especially if you're in your 50s, you can actually contribute more to a lot of these accounts because you are 50 years or older. But again, I will link those articles down below so that you can go and take a look, because they do have some, like with the Roths and the retirement, where if you are a certain age, they'll let you contribute a little bit extra to kind of help speed you up so that you can have a nice nest egg when it comes to retirement, because we just don't know. We don't know what Social Security is going to look like. We don't know what the cost of goods and services are going to be when we do reach our retirement years. And these are some of the things that you have to think about. Do you plan on having a paid off home? Do you plan on retiring at the normal 65, 67, or do you want to retire early? It doesn't matter how early you want to retire or how late in terms of early you want to retire, because some people want to retire at 55 because they love the job that they do. So they don't want to go all the way up to 65, but they would like to retire at 55. Well, these are just some of the different investing accounts that you can have in place to work for you. What about dividends? That's another type of account that a lot of people have, including myself, that you can invest in companies, and as an incentive for being an investor, those companies will pay you cash. I don't even know how easy to say it. Cash for just owning the stock, and then you just reinvest that cash back into that company and just continue to compound and grow month over month over month. And you would be surprised how fast this stuff accumulates. Every little bit counts. Start with where you are. It doesn't matter, about anybody else's situation or online. Don't get caught up in the comparison thing. Take the golden nuggets. Be inspired from other people. Take what applies to you and apply it to your situation. You don't want to craft or create a retirement plan that is for someone else online situation, because again, that's not good, that's not reality, and that's not your reality. So I'm hoping that you guys enjoyed this video. Leave me some comments down below. Do you have any of the accounts that I mentioned? Do you feel like you got a later start in terms of your retirement? What have you done to kind of speed up the process a little bit? I really enjoyed talking with you guys down there. Don't forget to follow me over on Instagram. Don't forget to like the video if you haven't. Subscribe to the channel. What y'all waiting on? Subscribe to the channel and hit the little bell notification button so that you don't miss a video every time I upload. And until next time, I'll see you in the next one. Bye, guys.